Yeah, so let's talk about capital gains. And, it does always start back to ordinary income, which we talked about previously, right? So ordinary income is where you have the money, where you've earned the money initially, but what do you do with your money now to make that account grow, to maybe grow your money and ultimately end up with more funds than you started with? And that's where capital gains comes into play, okay? So this is where the investor has basically made an investment into assets, and this could be any number of things. This could be real property, this could be equity in companies or something else, fixed deposit accounts, brokerage accounts. There's a lot of different ways that you can grow your money over time, and all of these are acceptable, but there's definitely pitfalls in each one that you want to be careful about. So let's look at two that I think are pretty common, and we'll talk about some of the pitfalls that are associated with each. But keep in mind that there's a lot of different, this is not an exhaustive list, and there's a lot of different things that you should be looking out for. Probably the most common way that EB5 investors end up realizing capital gains is through real property, right? And this is from the purchase of a property. It could have been many years ago. It could have been just a few years ago. I know COVID has led to a lot of increase in real estate values across the country, and so people are seeing some exceedingly high capital gains in a short period of time, which is great. So, if you bought a property, whether it was many years ago, whether it was a few years ago, one of the things that USCIS wants to see right off the bat is how were you able to purchase that property, okay? So you're gonna have to show that ordinary income, the one that we talked about, right? Where did that money come from that you were able to purchase the property? Was it a gift perhaps? The property itself or the funds to purchase the property? In places like India, we see this very often where there's ancestral property that's been handed down through the generations, and maybe an investor came into possession of that property. As a result, over the years, that property is now appreciated significantly in value, and they're now able to sell it at a much higher price. That's great, but you have to be able to show two main things. One, possession of the property, and two, that the valuation of the property is accurate. The new higher valuation of the property that you're basically assessing it at is accurate, right? The documents that you would need to provide for this, obviously, from the purchase side, pretty straightforward. You're going to have to show the purchase agreements. If there's a deed of there's deeds that are changing hands, those need to be documented. Any property tax documents that you have over the years proving that you've maintained ownership of the property and paid the appropriate taxes on it is fantastic. And you're also going to want to show any of the funds that were used to purchase the property. If you put down $20,000 as down payment, you need to go back the years prior to the purchase date and show where that $20,000 came from. Then you get to kind of the point of, okay, well, now I'm ready to flip this property or basically sell the property to an interested buyer. Great. But USCIS is not just going to buy that, you have this property that's magically worth $800,000, right? So you're going to want to have to show comparables. You're going to want to show that this is a real valuation, that the person who's purchasing this property is a real buyer, and that they're not paying some inflated price just to show USCIS that it's now worth a certain amount. So you're going to want to get an evaluation done either by a bank or a valuation company, an appraisal, as we call it in the United States. I've also seen people get creative when they're basically figuring out if they're going to do a partial investment or something like that, what they're going to expect to get from a sale of their house. And that's where you might ask a realtor to provide some comparables so that they can kind of look at that and assess kind of what range their property value will be at. And that's kind of the big one. Real property is definitely the way that a lot of people end up using getting the money for an EB5 investment. The pitfall here really is making sure that you've maintained ownership of the property, how you came about to own it, and then ultimately that you're selling it for a fair market value or close to a fair market value and not for an inflated price that can't be justified. Another common way that we'll see, and this is definitely for the entrepreneurs out there, is a sale of a company. And this is a very similar idea, right? This is a very similar idea to the real property. Essentially, you've invested early on, you've purchased something. In this case, it would have been your business, right? And that business has now grown to a point where you're able to sell it to a buyer or hand it off to somebody else for a price and essentially end up with a sale of an asset. This company is the asset in this case, right? Here again, you're going to have to show the exact same things as before. How did you invest into the company initially, right? How have you maintained ownership of the company through time? You're going to have to show those corporate documents showing that you've maintained ownership. It doesn't have to be a full 100%, right? You could own shares of a company. You could be in a partnership. That's okay. You want to show your ownership interest. You want to show that maintenance of that ownership interest, and you want to show the initial capitalization and where that money came from. Finally, you're now at the stage where the company has grown. Well, you wouldn't need to show that as well, right? You probably have to show financial statements. 7 years is the magic number with USCIS. That's what they're going to want to see. So if you've got a 30-year-old company, you don't need to show all 30 years, but you definitely need to show the last 7 years of audited financial statements, corporate tax returns, basically just showing that the company has grown. This is how much revenue it's producing. This is how much profit, whether, maintained within the company or taken out as dividend, the company produces. All that needs to be documented. And then finally, the very last step is, again, the sales agreement. Maybe you're offloading shares, maybe you're selling your partnership interest to somebody else. All those things need to be memorialized into a written agreement. And again, there's going to be some fair market calculation here, right? You can't just sell your shares for an inflated price. You can't sell your ownership interest for an inflated price. If it's your company, you can't just sell the company for whatever price. You need to have some basis, some kind of calculation for how this comes about. Now, there's not like there's not a set way to come up with a valuation for every business, right? Obviously, banks can come up with ideas and ways to value different businesses. But if you find a buyer and they're purchasing your business from you for a specific price, you need to be able to justify with documentation, and that very well could be the revenue stream that you've generated through the company. That can be the amount of goods that you're selling, the amount of trade that you're conducting. All those things are holistic, approaches to answer the question of why am I being able to sell this company for a certain price? And you need to show that to USCIS so that they don't basically call you out and say, well, we don't really believe you. What can you show to us? Be proactive, put that valuation kind of at the forefront and say, this is how we arrived at this number, and let USCIS know that this is a very legitimate way of selling your company or any other asset for that matter.